Well, hello everyone. It's so amazing to be here. This is perhaps one of the coolest stages I've ever had the pleasure to be on. We're going to continue talking about this very important topic about deep tech funding, and I have an amazing group of experts with me today, which I will give them the opportunity to introduce themselves. So, Salah, let's start with you.
Sorry?
Let's start with you. Just please tell us who you are and what.
Yeah, sure. Hi, everyone. I'm Salah Francén. I'm an investment manager at Navigare Ventures. We invest in early-stage science-based innovation.
Thank you,
and I'm very happy to be here.
It's great to have you. Mart?
Yes, hello, my name is Mart, and I'm leading Uni Tartu Venture, which is the owned 100% by University of Tartu investment company, and helping researchers to become entrepreneurs and to build up investable companies.
Thank you, Mart. Bart?
Yeah, Bart, we all sound the same. So I'm Bart, I'm a board member at the European Innovation Council, so a European structure, EU structure focused on deep tech ventures.
All right, amazing. So we'll have around half an hour discussion here about the complexities of deep tech funding. You have a QR code behind me. If you want to ask any questions, make sure you go onto the app, and then we'll have some time for Q&A at the end. So let's get started. I don't really know much about the topic, so I get to ask all the awkward questions. And let's just start by laying out the problematic. I understand that there's a significant difference when it comes to raising capital if you're a deep tech startup versus being just a non-deep tech startup. Can you tell us a little bit about, from your perspective, what's the main difference?
Should I start?
Yes.
I think the main difference for me is that it needs to be based on true science. And that means that it needs to somehow come from deep thinking. So for me, deep tech is kind of where you have this fantastic idea, you're not sure that it's actually going to work. You might have come up with a fantastic material and you're able to create 5 milliliters of that material or 1 centimeter. And if you are able to create it at a scale, then it's going to disrupt the complete industry. And I think the big difference there is that investors need to kind of have patience even more than you would with a normal, like a not as deep tech company. And I think it's also kind of the ideal investor, I think, is someone who can also understand the research and at least at sort of a hand-waving level, be able to follow the progress from a research perspective in the beginning.
Right, and I think we'll get into more specifically what are the main challenges that this causes for companies that want to raise capital. What about you, Mart? Bart, anything to add to what differentiates deep tech startups?
Yeah, I think the risk split is different. So and your learning curve in different trajectories is different. So it means that with a deep tech, you cannot build in the same as a consumer app the really quick learning cycles. Mm-hmm. But the beauty of it, once you're figuring out the product market fit, then you have the long-term advantage thanks to the deep research behind it. So it means that you have to split your attention and also to manage the risk differently. So that's the part of it. And also, yes, you need a different type of like surrounding ecosystem to succeed. And maybe the last point is that the market is, most cases, global quite soon already.
Right. Okay. Bart?
I agree. But as I said, the fundamental element is, of course, that on deep tech, it is based on research. And that makes it a bit harder. You need to develop defendable IP, the intellectual property. And the fact that it's a bit harder usually means that it takes a bit longer. It takes a bit longer to find the technology, to bring it to market, and to scale it. And if then we link that to venture capital or how to fund it, it falls a bit outside the traditional structures in how funding works. We're all somewhat comfortable with the software or SaaS or digital funding, where funds usually have 8 to 10 years of a lifetime. For deep tech, often that's not enough, because researching, bringing it to market and scaling it takes more than those 10 years. So basically it also changes the way funding in deep tech is set up. And that's a fundamental difference. The advantage is, of course, that if you have that advantage, it creates something defendable against competition. And I believe there's a huge opportunity for European companies because of that.
Okay, so I've heard so far that there's a number of things like longer times to value. There's the risk spread. There's the specialty of the founders and very specialized knowledge of these type of startups. I would like to understand then what are the main challenges that both parts of the equation face, both for startups to raise capital, but also for venture capital companies to assess the viability of these startups. Let's start talking a little bit about the challenges that VC companies face when making these assessments.
Yeah, sure. I think there's a multitude of them. I think my favorite challenge is when industry isn't really ready for the innovation, because that means that we're onto something. Quite often, big industry changes quite slowly, but they're also feeling this deep need of sort of change. And I think asking industry can get you a part of the way, but it's really sort of pushing them to be much more innovative. And I know that Mart and I used to work a lot with innovation in our previous work, and it's super interesting to see how challenging it is for the kind of future buyers of the product to really dare to take that leap and dare to try to do something different. So I think that's one part of the puzzle that's really interesting and challenging. And then I think if you're really looking into sort of deep research, the only way for you to mitigate that risk is to understand whether the physics will actually work, or whether biology actually says, yes, this is possible. Right. You know, if you're trying to get energy from gravitation, please don't try that, because it's just not going to work. Because if it worked, then gravitation would decrease and we would start soaring into air. So it's kind of, you know, physics.
Right.
So I think being able to understand the basic concepts, and then either having people on your team or connecting with researchers and experts that you know that you can trust. That's also a piece of the puzzle, kind of reducing the research risk. And then I think it's all about sort of that patient relationship with the founding team, understanding what they actually are driven by, what they're really looking for, what drives them, what values drive them. Because a lot of people actually want to make the world a better place, and sometimes that's great, but your innovation will be a great company for 5 people for the rest of your lives, and then it's just not for risk capital.
Right.
You know, so it's like the scalability needs to be there, and that can also be sometimes a bit challenging to figure out whether it's actually going to be there.
Mart, do you see anything additional to that could represent a challenge for VCs?
Yeah, maybe highlighting the team, because it's. I think this is like the key at the beginning, because the starting point has been really might be minus 10 years on the momentum when you're deciding to spin out as a company. And you need different competencies on that mind to reach the market and reach those kind of commercial agreements. So the key is how you're building up the openness and also the readiness to bring in new competencies and evaluating what you have and what you don't have. So this is, I think, really the momental moment to make it right time, not too early and not too late. I think sometimes we are seeing the cases when those team formation decisions are postponed, and that's not really good starting point for a common ground.
Right. But you've been on the other side as well. As a founder, what are the main challenges that you see are more relevant in trying to raise capital for deep tech?
Yeah. Having been on the other side, being a founder is really tough. We always romanticize it a little bit, but there are so many highs and lows in a company, in any company. And that's only usually the successful ones. Mm-hmm. In deep tech, the fact that it's even harder and it takes a bit longer, it even puts a longer challenge on that, because if you're a founder in deep tech, it's not like in software you can say, well, I'll try for 2-3 years and then I'll move to the next one. Mm-hmm. It's nearly a commitment like for 15 years, right? So in terms of founder, it's really tough. And the second thing is the fundraising climate. As a founder, you're always fundraising. One of the difficulties that we have in Europe versus the US, so I lived in California for 5 years. One of the things that Silicon Valley does fairly well is that they set up a kind of a funding design, saying, well, if you start very early, you have already a fund who comes in, and they basically dictate or they give you the terms how you will raise your next round. So they come in and they say, well, if in 18 months you achieve these and these and these targets, or 3 years or whatever the timeline is, then we'll do a valuation, we'll continue around, and we'll find other investors. We don't have that kind of ecosystem yet. That's one of the things that we, with EIC, which is the European Innovation Council, try to do, is trying to be that partner along all the steps, because we invest from we do it via grants on the research side. We also do in the transition to companies and in the scale-up side. I think it's an interesting structure to look at, because it takes a bit away the pressure of doing fundraising alone by founders.
Right.
It shares the burden or the effort.
Okay, and I think we'll get into this aspect of the different type of funding models based on the stage, because I think that's quite interesting to get into. I just want to maybe touch back a little bit, because you mentioned that it's necessary for VCs to have access to the right pool of knowledge in order to be able to assess. But I would imagine that when we're talking about bleeding edge technology, it's not like there's a vast pool of people to choose from. Say, oh well, we'll get an expert, because some of them are at the frontier of their disciplines. How do you solve that problem? How do you go about finding the right people that can help you assess them?
The fantastic network that we have.
Right.
No, but I think, yeah, I mean, yes, we of course look for cutting edge or even bleeding edge technology, but quite often, especially if it's a founder that's going to start a company, the founder has to be able to explain what they're doing, at least to someone who has like a relevant research background. Otherwise, there's going to be a problem. They're not going to be able to sell to anyone. So I think that part is kind of crucial. Having someone on the team that has communication skills, that they can actually explain what it is they're trying to do, to like not my grandmother, but to someone who is a researcher.
Right.
Yeah.
Last night over dinner, I was having a fabulous conversation with Kat. I don't know, she's somewhere around here, but she was highlighting the issue of that scientists they're very honest. If you'll ask them, they will tell you, well, yeah, this is what we can do, this is what we can't do. Founders tend to be more sales-oriented when they're trying to sell their idea. Is this also an issue that you find when a founder of a deep tech startup is trying to raise capital versus perhaps someone that is more about selling you a grand vision of the future?
That's a good question. I think many VCs would need that kind of sales pitch that would be very sort of inspiring and engaging. I think for us, the most important thing is that the kind of innovation and the research is there. I'm a mathematician myself, so I'm quite used to speaking to slightly introverted people, and I'm quite good at seeing past that. And then, of course, once you really start sort of setting the fund up for like a pre-seed or a seed round, probably a seed round, then it starts to be important that you have a good balanced team, that you have someone that could support in the kind of in the funding, in the raising of funds. And there, either it's someone like a PhD student or someone who happens to have those skills, or it's someone from our network that's interested in joining, or it's someone that they find themselves that they trust and like.
Yeah.
I mean, there's this saying that introverts love extroverts because they can just like hang out with them and they don't have to talk.
Mart, what's your view on that?
Yeah, I see there is the difference, also the kind of bit of like generational shift what's going on now. And what I see that like the new generation of founders, researchers, they already are used with it. And what we have figured out interesting pattern when we are analyzing the teams who are becoming faster investable and who are not, is actually a fact. It relies on what the part is saying. People who have made the postdocs abroad, and especially in US, they are actually having the researcher deep knowledge, but also entrepreneurship mindset there already at the beginning of journey. So I think it's really hard to top up later this kind of additional perspective. But when you learn your research work, and you learn also same time entrepreneurship by seeing the role models and then seeing next to people yourself who are becoming entrepreneurs, then you're ready to take the two seats at the same time and to play both games very well.
Right. Bart, anything to add to that?
Yes. it's not so much sales pitch, it's more telling a story,
Yeah.
right? It's conveying something that you incredibly believe in. And it used to be a bit more the salespersons, because that was fine. Startups didn't, or were not very technological at certain moments, so you had to explain what it would serve to, and we didn't go, the pre-deep tech, you didn't have to go that much into detail of the technology, because it was usually basic infrastructure and basic software stacks, and right? Now we come to a phase where the deep tech technology itself is a core principle of the startup. And I believe that also it's also on the investor side. It's a different kind of profile of people that are deep tech investors. And that makes that they are interested in the technology. I've seen the discussion shift a lot into only the grand vision and what it should lead to. And of course, it leads into that, to much more, how can we understand the technology? But if I see in pitches how much time that we spend in the technology itself, it's really a lot.
Yeah.
Because all people around the table are really interested in it. And it is because very often the kind of startups that we're talking about basically have an impact on our life. It's often about climate change or energy transition. It's about healthcare, medtech. It's about defense. It's about technologies that are very close to life and having an impact on life via the technology. So I believe the way of pitching it, it's fine. It's telling a story. And of course, you have your vision, but going into the technology, I think it's really an asset.
Right. Okay. Now,
Can I just add something to that? Because I really like what you're both saying. And I think, because we talk about kind of the maturity of the industry that would be the potential buyer. And we talk about the stage when it's nerd to nerd. And then I think it's quite good to have this sort of, a bit sort of just passionate researcher. Because they will be able to sell to their peers in the companies that they're selling to.
Yeah.
And then as it evolves, top management might start getting involved, and then you need that kind of skill that you're able to pitch it in more of a standard startup way.
right. Okay. Now, I'd like to move the conversation a little bit towards helping startup founders, deep tech startup founders, understand what are the funding models that are available to them. Bart, you got it already started us. By talking about the differences between the U.S. market and the European market. So, what is it? What's available? If I have a fantastic scientific idea that can be turned into a company, what do I do? Where do I start?
It's not that different from traditional technology funding, right? It depends a bit on your initial stage. You start with a lot of grants. That's something that is much more available, because grants is very often public grants allow you to deepen the technology research. That's a big fundamental difference, and that basically continues, if you handle it well, along the life cycle of your deep tech startup. Because you cannot do the research and then build a company out of that. You have to keep on researching, and there is ways to scale the company and at the same time also have grants so you can deepen the technology along the way. So I think that's a big fundamental difference. A second one is that you need a bit more capital.
Yes.
So it's you need more capital, so you need to pool it in some way, and there's ways of pooling it. You have public finance, you have VCs. There's a lot of ways, a lot of elements available. As I said, from EIC, we try to fund from the research phase until the scaling, and it goes typically in the scaling phase. We invest. The minimum is 500,000. The maximum is 15 million per ticket at this moment, and I hope it'll go up at a certain moment. That's what we should, especially again because Europe has really a fundamental opportunity to be a leader in some of the domains. So we have to do that faster and with higher tickets. And I think we all have to play a role in that. But yeah.
Yeah. Mart?
I think somehow what we are naming that capital has a DNA. So when you have the grant funding and you're really good at doing it, and it's really hard to start to talk with the risk capital. So that's different type of questions. And what I have seen what I'm also recommending for the teams to take at least small piece of equity also for giving and taking the private capital really early, not too early. I think this is also another topic, but rather early and get learning of those questions answer. And once you need the bigger rounds of the capital, then you're quite mastering also with the risk capital mindset. So I think it's kind of the training camp. Next to the grant funding, you have to build up also the capability to start to have the good dialogue also with investors. And once you need the scaling up, then already you're already used with that type of dialogue already. So you are on the both tracks really good of keeping the dialogues, because you have to switch the gears. And then later on, of course, combining it with the grant capital, that's all good. But when you're becoming dependent really primarily with the grant capital and you're not able to bring the first round of investor side, that's, I think, the trap sometimes what companies facing.
Okay. Bart?
Yeah, and maybe something that has changed over the last years is that there's a way to combine different sources of funding.
Yeah.
And you can really, the fact that there's a combination, you can scale down your initial requirement of capital to very small amounts. And just to take an example, often you will have a public fund that says, okay, I will invest. They can do maximum half of the amount. They say, but you need to do the rest in private. Let's say an easy amount, $1 million. That means that you have to find $500,000 in private. You find some business angels, you find some private funds. They said, yeah, but you need to prove more market traction. So that means that of the other 500, you need 250. I said, yeah, but there you can have a small grant. And at the end, you can have a crowdfunding campaign, if you like. And the crowdfunding campaign of 100K can bring on all the other funds, because the crowdfunding campaign brings in your private capital, which proves your traction, which gets you your public grant. So I think there is a way to be innovative as a founder as well by combining all these things.
And is this something that you develop as you go along? Would you recommend to start it from the very beginning as you design the solution? What's the best approach?
I think the best approach is to design it up front. The funding design is something that we still lack, because we don't have a grand structure of doing it. It's still fairly new, right? I think we will get there. Yeah, it needs some successes, it needs some exits so that funds can reinvest again. Those are coming. And that means that at a certain moment you can really try to design the way you want to scale and fund your startup. Yeah. But thinking it upfront and how you structure it and how you do it, you can really save a lot of time. What happens now very often is you start with your initial angel capital or whatever you start with, or grant, and then you say, okay, yeah, now I have to do a different round. You have to reach out to different kind of people, but they have issues with how it was structured, and then you lose time again. And often to a founder who says, I have to do fundraising, it's take half a year off nearly, because you're pitching half a year everywhere. So we have to decrease the time to do that, and you can do that by designing it up front.
Yeah, having this long-term funding strategy is good to have it. Reality is always different, that's for sure. But it's good to have the plan, then you can adjust. But when not only from the round to round, I think this is not sufficient strategy. So, and also investors seeking the kind of perspective about the progress. So if you're telling the long-term story and then you're showing the progress, then it's also easy to believe the story. So I think having the roadmap of technology and go-to-market, but also having the funding structure, the strategy at the place, I think that helps everyone to understand what you're aiming for and what is actually the capital need for. So that's another aspect to be more clear. Then it's easier also to follow from the stakeholder side.
Right. Okay.
And it's also something that is building up the co-investments, and the how we are co-investing in deep tech is something that's now accelerating. If EIC in its current structure started about 3 years ago, so the total fund is about 10 billion, but the venture capital side is 4 billion. At this moment, the deal, in terms of deals that we're approving, we're at 2 a week. But the most interesting side then is that we crowd in, or we each euro that we invest, we are now at 3.5 euro from private venture capital that is co-investing. And that's interesting, because it means that it's not just a public one. At a certain moment you'll have syndicates, specifically also some private VCs, but also regional capital. No regional VC or public fund wants to miss out on the local winner.
Right.
No. You have to know it's impossible that the French government will not co-invest in a French startup if there has a potential to be big. And it's the same for every country. And so that's something that we're gradually building up.
Yep. Now, just as a reminder to the audience, there's a QR code behind me. If you have any burning questions, make sure you scan the code and you can submit your questions. We'll have a couple of minutes for Q&A at the end. Now, I want to ask an awkward question, and that's why I'm here for. Perhaps it's too obvious, but I see it, and maybe, Sally, you can correct me if I'm wrong here. As a mathematician, we have the academia realm, and we have the business
the problem
realm.
in Europe, and not only in Europe.
Okay, that was exciting. If you've spent all your life working in academia, and perhaps you haven't done a business before, perhaps you're used to certain things like publishing papers.
Yes.
Well, maybe you don't want to be as open with your IP when you are in a business. So how can entrepreneurs? What are the practical strategies that entrepreneurs can follow in order to balance this difference in approach?
We keep building new stuff. Don't necessarily want to.
We have someone who's kidnapping our panel.
Being hijacked.
It's really cool. No, but I think that's a super relevant question, and I mean, one of the things that we kind of struggle with at Navigare, or struggle, but think about is we have fantastic researchers and they come up with fantastic results, and they might actually want to continue doing fantastic research. And then finding those people that would be willing to then spin out that idea and build a company out of it can sometimes be a really good vehicle of doing that.
Yep.
And then it's quite clear that whatever research was at the base of this specific thing then goes into the company. And then it's a discussion with the researcher whether they would want that all of their future innovation would go into the company as well, or if they would like it to be very clear and crisp defined when I do, because researchers do a lot of different research. So when I do things that relate to this specific material, then yes, the IP will go to the company, and I'm fine with that. But if I do other things, then it's still my own research.
Okay.
And I think that might be a difference between Sweden and other countries, that the researcher owns their own research, so they own the rights to what they innovate.
Yep. Mart, any practical advice for startup founders, deep tech startup founders?
Yeah, I think it's important to agree rule of the game at the beginning of the game. So that's I have seen and learned that when you're spinning out from a university, kind of conditionally, once you are ready to spin out actually, then you know already principal terms, how you can spin it out. Investors seeking that kind of clarity and the visibility, and also for your team is kind of confident that once we are choosing, because quite principal decision it was the researchers to become entrepreneurs and to build a company. So there is sometimes even not a way back even. So I think we have to respect that type of decision from academical side and give the confidence and also give the principal conditions based on what you can use the IP and what belong to university, what is for other research domains necessary, and what is the IP what you're going to create and what belong to the company. So, and what we have learned when we are agreeing on the conditions at the beginning of a journey, then it's so easy to enjoy the journey,
right.
And everyone respect each other. So, but once you have to negotiate, and the moment when there is no pre-agreements, it's hard, and everyone, most cases, not a win-win. So sometimes it feels that someone is still not getting out best of it. But idea is that when the IP is created, the actual value of IP is zero until it's not put on the market. So that's, I think, the fundamental understanding also for research community side, to help that the entrepreneurship and the companies, in my view, are the best effective vehicles to bring the research to the market.
True.
And we have to respect and also from university side, give that type of clarity of roadmap, how to make it happen.
Of course. Bart, anything to add to that?
I agree that we have to preset the rules, but I also think that we have to keep in mind that in terms of research, Europe is really good. It's basically, there was a study now from the European Patent Office where they made kind of a comparison, and Europe, Asia, and US are basically at the same level. Where we are less good is how can we transition all that research from patents into companies. And I found it really staggering to hear that it's over 95% of research that just remains patents, unused theoretical, that is not transitioned into. So there's an incredible opportunity there that is transitioning more IP into companies. And we have to do that while respecting who develops it. But nobody wins with having theoretical sleeping patents, right?
Of course.
And so having that kind of transition, that can be a total game changer. And if it's done by harmonized IP rulings on who does what at a certain moment. But I think the main objective should be how can we transition more research into companies, and maybe later on, how can we spin in research into existing companies that are in need of research? It doesn't always have to be spin-outs. You can also spin in research, because sometimes a company runs out of competitive advantage, and you can collaborate with university or research to spin in new or to build on that. That's a second step to work on.
Okay, now we've got a question here. I'm going to go to these questions first. Let's see if we can answer it before we close our conversation. But the question here is, how do investors look at the long period of potential returns or loss? And how do investors see the communication with scientific researchers as founder team members? Who wants to have a go at that?
How do investors look at loss?
So how do investors look at the long period of potential returns or loss?
Oh, right. Yeah.
The P&L.
Yeah. I think in general, if you are kind of starting, or if you have a deep tech company, choose your investors wisely. Choose the ones that will have the patience. Choose the ones that will be able to support you. And I really like your idea about having this sort of investment strategy almost. Like these are the investors we want to go with at specific points in time. Because different venture capital companies will have different focuses. They'll have different, some have checklists. Others go more by science. So just finding those investors that you like, because you will be working with them for about 20 years, and that you feel can support you at the point where you are. I think that's incredibly important, because if you find an investor that comes with set milestones in 18 months and otherwise you have to shut down, that's maybe not optimal. It might be, but it might also not be optimal for the point where you are with your company.
Mm-hmm. Any other takers?
Yeah, I think, well, as you said, if you know that your company is going to take quite a while from where you are to a certain kind of exit, choose the investors that can stay with you during that period. They call it patient capital. But if at a certain moment you need an investor, but you know on the structure of the investment fund that they're in year 5 and they have to exit everything by year 10, that means that they maximum have like 3 years before this. It puts a pressure on you. So as an entrepreneur, you have to choose and you have to map the investors that fit the lifetime of your company, because otherwise you'll run into trouble.
Yep.
Yes, I fully echo choosing the right investors. That's the first choice. The right decision to make. And the second is being really transparent and also being honest where you are and where you're not. So I think that's also help manage expectations and also ensuring that we are both on the same boat. And more we know, and then higher probabilities that we can help each other. So I think that's another second important, that build the relationship, manage expectation is absolutely key on where you're already on a journey. But yes, first of all, make the right choice of right capital and right mindset and right network, adding value what investors bring on the table.
Right. Okay, well, we have less than a minute left, so I will just close by saying that this is extremely exciting to see what's happening in this field. Ladies and gentlemen, the playbook on how to raise capital for deep tech is being developed here at Latitude59. Thank you so much to our panelists. Please give them a big round of applause.
Thank you.
Thank you all.
Thank you.
Enjoy the rest of the conference.